Hello, I'm Alex Davies, founder of Wealth Club. Today I'm with Stephen English of Blankstone Sington to talk about their AIM inheritance tax portfolio. Stephen, tell me a bit about the AIM inheritance tax portfolio.
Okay, Alex, well, like most other providers, we invest in a diversified portfolio of AIM stocks, and after 2 years, the value of those stocks drop outside of your estate. So we've got a minimum of 25 stocks, a maximum of 40. What we're looking to do is protect that value, but over time, try and grow the value of that portfolio in as a considered manner as possible.
There's quite a few of these portfolios out there. What's different about yours?
Everyone's going to claim to be different, aren't they? This is our DNA. We've been doing stock picking in small caps since the firm was founded in the 1970s, and that helps. We do everything in-house. We do our own dealing. We add alpha that way. It's essentially you can deal well. Everyone knows our dealer Peter Kelly in the market. We do our own custody, our own settlement, and all of those cost savings then we can pass on to other clients. What also makes us different is our size. We will cap the strategy to maintain our investment performance. Around 150 to 180 million pounds we see as a sweet spot. That allows us to be unconstrained. We can buy larger companies or we can buy smaller companies. For the time being, we're seeing the most value and the best growth opportunities at the smaller end of AIM. And that's where we're very much focused on. And as they get bigger and more coveted and more expensive, we look to sell them, and then we'll recycle and go start again and back into the cheap, unloved, overlooked stocks.
Tell me a bit about Blankstone Sington.
So we were founded in 1976, which coincidentally was when business property relief came into existence. And we are a private client stockbroker and investment manager by heritage. We are owned by the family and their directors, and we do discretionary and advisory private client management.
And how long have you been managing money?
I joined the firm in 2002, and on this service in particular since 2010. So we're not Johnny-come-lately to the party, and as I say, this is very much within our DNA. We've always done this, and we've got the systems to be able to do bespoke portfolios for clients.
And is it just you managing the portfolio?
I have sole responsibility for the actual stock picking side, but I am ably supported by a wider research desk, of which I am one of 3. And then there are a team of investment managers who handle the day-to-day contact with the client and reporting to them, communicating and order processing.
So let's talk about investing in AIM. It's very risky, isn't it?
It's a bit like, AIM can be, definitely. It's a bit like the Galapagos Islands. There's all sorts of weird and wonderful species on AIM, but if you invest judiciously, you can deliver very outsized returns for your clients. Unfortunately, AIM has a bad reputation for a good reason, because there's a vast swathe of AIM that you wouldn't touch with a barge pole, or you shouldn't go anywhere near. But there are certain things within your purview, which is control of balance sheet risk, earnings risk, and valuation risk. And like a Venn diagram, they're all interconnected to a degree, so there are certain levers that you do very much have control over. So while AIM as a thing, as a homogenous kind of class, appears very, very risky, by targeting good solid companies that are profitable, that are generating free cash flow, which is the true oxygen to any business, and paying a dividend, you can filter out and weed a lot of the chaff that essentially go down to zero.
And what sort of companies are you looking for as a particular market cap?
The most value is kind of sub 150 mil market cap and below. We do think the upper echelons are overvalued currently. And if you ask in terms of what characteristics are we looking for in companies, then competitive advantage, what is it, and do we think that is sustainable? Because most businesses' competitive advantage is competed away through competition. Management, the smaller the company, the more important the manager is, and you won't see the manager quality appear on any spreadsheet or filtering system, but over time they're the people who are going to deliver that compounded results for you. So we spend a lot of time thinking about the quality of management, and in particular I call it the 3 I's process. What's their integrity like? What are their incentives? Are they aligned? And what's their intelligence like? And in fact, intelligence takes a distant 3rd place to the first 2 of those. If you can ally that with a superior capital allocator, So when they know when to buy shares back, and we do give them guidance on this and when to increase dividends, when to do M&A, when to invest in their own business. If you can find a manager who can do both of those things well, you can deliver superior returns for your investors.
Do you want to talk about some of your investments?
Sure. Maybe some recent additions. Mission Marketing Group, which is a media agency, a bit like a mini WPP, and in fact it's probably where WPP wants to get to now. And I put that on in December last year. It was a £40 million market cap, which was too small for a lot of my competitors to be involved in. At the time, it was on a PE of 6. It was a media cyclical perceived company and a micro cap at that, and the free cash flow yield was actually 20%, and you very rarely see a 20% free cash flow yield unless that company's in deep distress. I felt the debt was too high. It was nearly £9 million. I communicated this to management. I understood that they were going to do no more acquisitions, so I could see net debt falling rapidly and that repatriation from debt holders to equity holders. You fast forward, I also identified some hidden value. They have an incubator business within the wider group, and they sold one of those businesses, Broadcare, for £4.4 million. So when I swiped, the balance sheet was much improved. And there is actually another business in there called Pathfinder, which I think is already worth £5 million. So these are significant additional value creators that they're doing as well. Share price up now 70% since December. That perception of being a very weak cyclical company is starting to change. We've gone from a 6 times PE to a 9 times PE. And that's, call that a recovery or a special situation, but we like to have some of them in the portfolio because the portfolio should be a blend of stocks that do different things and zig and zag at different points of the cycle. Another interesting one for the viewers, maybe one called Echo, ECKOH. These are very much involved in software which encrypts card payment details when you call up an operative in a call center. And believe it or not, this is the soft underbelly of a lot of fraud now. Call center, when you give your details over the phone, that call center operative can use that for malfeasance or buy stuff online, which is fraud. It cost the UK economy £500 million last year. It cost the US economy $6 billion, and that fraud, because it is a soft underbelly, is growing 20% per annum. So this software company really doesn't have that much direct competition. They are best in class. They've got very strong IP. They've got very high levels of recurring revenue. They've got over £10 million of net cash on the balance sheet. And their new business has just grown 47% to a record level. Their software, and it's a very powerful push factor, cyber insurance for the US companies is going up at such a rate, it's cheaper to use Echo's software than it is to pay the insurance. And the runway is vast. They've only got a 1% market share in the US and a 3% market share in the UK. So we see years and years of growth ahead of it.
And another example?
Maybe not a new addition, because we do like to hold on to our stocks that can compound. That would be IG Design. We've held that 4.5 years. The CEO is one of the best CEOs I've met, not just in AIM, Paul Feynman. He's an aptly named character. He's a fine man indeed for what he's done to that business. He's brought it back basically off from its deathbed when the share price was penny stock. Since we've owned it, it's delivered 600% total return. Notwithstanding that, it's still a buy today for new clients. They are involved in the celebrations market, creative play and stationery. So if you see Marvel rulers and rubbers, they will have made that. They actually sold 500 million meters of ribbon last year, 20 million photo frames. So it'd be unfair to call it tat, but it's anything related to celebrations, in particular Christmas, where they make wrapping paper. He's executed a buy and build strategy, but there's also very strong organic growth, and operating margins, because they're getting such scale, are now starting to increase. Their acquisition last year was fantastic. It was less than 5 times earnings, has increased their exposure to the US and brought Walmart as a key customer, as well as Costco. And in the UK, their key customers would include the likes of Tesco, Aldi and Lidl. Growing very, very nicely. Net debt has fallen a lot. I think there's going to be another acquisition in the near future.
Of course, not everything goes to plan. Tell us about one that's gone wrong.
One that was a body blow was Shoezone. Up until August, Shoezone was significantly outperforming the general retail sector, including the FTSE 100 retailers and the FTSE 250. Operational excellence is imbued within that whole firm, and culture. even they were caught by the footfall on the high street, and we've seen data from the British Retail Consortium. In fact, June and July were the lowest trading months ever recorded, which meant that profits were going to be 14% lower than expected, and that saw the share price fall 50%, 50%. We've had a trading statement today from them which has confirmed it's going to be as we expected at their trading statement of August, and the share price is now up 10%, which is convenient for the interview, and it's a good news story to say, but they're still on a 9% dividend yield. The dividend's covered 1.7 times. There's over £11 million of net cash on the balance sheet. The CEO has replaced the guy there before. He was the CEO for 20 years, then he became chairman. Now he stepped back into the role. He is a fanatic about retail. He knows that you have to move very fast, otherwise things will come back to haunt you. And there's a burgeoning growth story going on in Shoe Zone now. Your viewers may start to see them appearing on more and more retail parks. They're big box stores. They're going to have 45 big box stores by the end of this year, another 20 next year. Long term, I think they're going to end up with about 100 big box stores and a smaller high street estate. Shoe Zone are a very good covenant. Landlords are offering them 1 year rent-free periods, which contributes most of their fit-out costs for these stores, and the payback is just over a year. So there's going to be no more special dividends for the time being. That's fine. You don't need to when your dividend yield is 9%, but they've got a better use for that cash now, and it is in this rollout of big box, which brings in brands such as Clarks and Skechers. And in fact, their best performing big boxes are ones where there is an M&S Food on the same retail park as well. That is a good demographic for them. So we expect their big box story, but also their online, which is growing very, very strongly now. They've got 1 million customers on their database, to see an earnings upgrade next year. And that PE, which is now at 7 times, it's ultra distressed despite being a very strong balance sheet. We expect that to go back towards 10 or 12 times next year. And that's the sort of value we're talking about when anything facing UK is just avoided and being shunned currently.
Obviously, AIM has come down a bit over the last year, but is there still a bubble because there's lots of money chasing IHT stocks, and is that still a problem?
It's a very good question, Alex. It's a very live question. We would absolutely agree there is a bubble at the higher end of the market cap within AIM. In Q4 last year, and people have already forgotten about it, some of these so-called quality companies fell 50% in a matter of 3 months. 1st of January, they rebounded, which has kind of created it's made investors maybe a bit blasé, but we think that was a portent of what's to come. If interest rates do start to normalise, and we're starting to see the yield curve in America starting to tick up once more, these growth stocks that are trading on very, very high levels, exalted PEs even, can very quickly derate, especially if you throw a profit warning in there as well. So we're very, very conscious of that, and we don't want to be involved in that space at all. So that's why we're currently focusing on the 150 mil market cap and below, where we're getting much more sensible PEs. The average portfolio PE now is about 16 times. If you put a fairly typical basket for larger companies, you would be paying north of 25 times. And risk to us is primarily a function of price. We've seen it in the Nifty 50 in the 1960s. Investors piled into stocks such as McDonald's, IBM, Kodak. These turned out to be high quality companies, and their earnings grew faster than the market. Unfortunately, you still lost money because you overpaid for that earning stream. And we see a rerun going on now on AIM. So it's vital for investors to look under the bonnet of their AIM IHT providers and really understand what sort of valuation risk they are exposed to.
And are you seeing good valuations for the types of companies you're looking at?
We are, and we kept seeing more and more and more value as Brexit was going so harder and harder, and we saw sterling go down to $1.20. And there's been a bit of a buyer's strike for anything UK exposed. So we've talked about emission marketing. Why was that on a P of 6? Well, it was a perceived cyclical company that was very exposed to the UK economy. But there's a certain point, especially when you've got a known negative unknown, which is Brexit is the ultimate, there's a certain point where investors overreact and the price overshoots to the downside. So we've seen a lot of that, and the portfolio as it stands today has had the best value that it's had in many, many years. Our dividend yield is now 3.8%, which is the highest it's been in many, many years. Q3 was painful for us. You've seen sterling go from $1.20 to $1.30 in the blink of an eye, and we've tilted our portfolio deliberately to the UK economy, so we will capture any sort of normalisation in sentiment towards UK PLC, and we're starting to the rewards of that are coming through in October.
What keeps you up at night?
Investment-wise, or generally?
Just investment-wise.
It's been tough, and investors are constantly having to reappraise their whole investment process, and this year has been tough. The Woodford demise has been very, very unhelpful for small caps generally. The baby is getting thrown out with the bathwater in the sense of small caps are tainted and perceived to be now viewed as just risky and avoid at all cost. I know some compliance departments have told their brokers to sell any small cap positions this year, or not to initiate any new positions. So you've had a bid taken out of the market that wasn't there. So profit warnings a couple of years ago that might have seen the share price fall 20%, this year has seen them fall 30, 40 or even 50% in some instances. The liquidity has been very, very low this year. So what's kept me up, it has been Brexit, but as we got to $1.20, I just felt, and if you look at purchasing power parity without getting too economic about it, sterling has already priced in a very, very pessimistic outlook for the UK economy. I think Brexit actually is going to be viewed as a bit of noise if we look 5 years into the future. If you want to be positioned to capture the upside today, I feel you have to be tilted very much towards UK exposed stocks, even cyclical ones, because the price is just wrong.
So if people want to put some of their ISA or investments away into an AIM portfolio, shield it from inheritance tax, why should they choose you to manage their money?
There's some great operators out there. I can only speak for ourselves. We don't run any model portfolio. Every client gets a bespoke portfolio which we think adds value, because AIM stocks always rocket on very little volume or a share tip over the weekend. So we'll move that to a hold. As long as there's at least 25 other buyers, you will get that. We feel a good service should also be good value. We deliberately have pitched our fees to be first quartile in terms of their cost effectiveness, and we don't charge any initial charge, nor do we charge any transaction charges. You know exactly what your charge is going to get regardless of how often we trade that portfolio, and there's no exit fees as well. We're unconstrained. We can go where many of our larger peers can't. We can invest in smaller companies, or we can invest in larger companies, and we like to blend the two. We also like to blend and have a foot in one camp, which is growth, and a foot in one camp that's value. Value's been a very painful trade, but at some point now we're reaching a certain extreme between value and growth. We think there's going to be a very rapid snapback where value is going to outperform growth. And this is very much in our DNA. We think we add value at every aspect of the service. It's in our heritage. We have the systems to be able to do it, as well as our dealing capability, which does add real value. And we don't rebalance unnecessarily, which is important on AIM when you've got bid offer spreads are quite wide of 3 to 4%. We only trade when the investment case tells us to trade.
Stephen English, Blankstone Sington, thank you very much.
Thanks, Alice.